The panelists on today's call include Albion Chief Executive Officer and co-founder John Bird, Albion Chief Investment Officer and Chief Economist Jason Ware, Albion President and Senior Wealth Advisor Liz Bernhard, Albion Partner Doug Wells, and Albion Senior Portfolio Manager Michael Kessler. We will now begin the conference call, and for that, I'd like to introduce President Liz Bernhard.
Thanks, David, and good morning, everyone. We're glad that you can join us today. We always look forward to connecting with you in this way. I had a chance to peruse the participant list before the call, and many of you have joined us on prior calls, so you know the program. We'll spend the next hour or so working to address the more common questions we've been hearing from clients over the last few months and in anticipation of the call today. Before we get started, a couple of housekeeping items. As you heard David share, we do welcome live questions during the call. The easiest way to do that is really to use that chat feature in Zoom and submit the questions. But also you feel free to, if you're dialed in, to use the *9, I believe it is, that David shared with us to raise your hand. And we'll do our best to answer those questions as we go throughout the next hour. This call is being recorded today, and we'll be sending out a link to the recording in the next day or two. So if there's something we talk about this morning that you really want to go back and listen to, you'll have the ability to do that with the link to the recording. Or if there's friends or family members who weren't able to join us on the call today, but you really like what you hear, you think they may find value in listening into it, please feel free to forward out that link to them as well. And if you do have friends or family members who are not currently working with Albion, but you think they would benefit from the services that we provide, please don't hesitate to send them in our direction. Client referrals are a big way that we grow our business, and we really take it as a compliment when clients refer their friends and family to us. Before we jump into our questions, which are fairly heavily focused on the market and the economy, I want to take a moment and just highlight some year-end planning items that we're working on right now. It is November 15th, which might be shocking to some on this call, which means we have 45 days or so left this year and even fewer business days. So we're really working with our clients to complete year-end planning items. And some of the more common items include, but are not limited to, required minimum distributions from retirement accounts, charitable contributions, whether we're helping to gift appreciated stock, or maybe we're using some of the required minimum distributions to do qualified charitable donations, QCDs. It's kind of a mouthful. We're also looking at required trust distributions and Roth conversion options. We all have a pretty good sense for what our income is going to be for the year and can really evaluate whether a Roth conversion is appropriate for us and makes sense to do it in this calendar year. Our senior wealth advisors have been reaching out to clients and will continue to reach out to clients on these items. But if you know that one or some of these apply to you and we haven't started a dialogue about them, please don't hesitate to reach out to us. We always like to try to complete these year-end tasks before the end of December. Realized gains and losses are something that come up at this time of year as well. We have been reviewing and harvesting losses throughout the year. We've been looking at realized gains and losses throughout the year, and we'll continue to do so in applicable accounts. If you do have significant gains or losses in accounts outside of Albion, or maybe you sold a home or another property this year and you haven't let us know, please do so we have a chance to discuss any planning opportunities with you before the end of the year. So with no further ado, we'll jump right into our questions. And I do want to just reintroduce the panel for anybody who maybe clicked in or logged in a little bit late. So this morning I am joined by John Bird, Doug Wells, Jason Ware, and Mike Kessler. And for our questions, we're going to really start off, looking high level and talking about the U.S. economy. We've seen a pretty strong GDP growth this year. The third quarter GDP growth was, I believe, just under 5%. But we've also seen things like a softening labor market. We've seen credit card balances start to tick up and delinquency rates rise also. So Jason, I'm going to pass the mic off to you for this first question and ask just, can you give us a sense from your perch what you're seeing and how the U.S. economy is doing right now?
Sure. Thanks, Liz. And thank you everyone for joining. As always, it's a pleasure to have this opportunity to talk to you today about the economy and markets and what's happening in our world. So to Liz's question about, how the U.S. economy is doing these days, just generally speaking, as Liz mentioned, the most recent top of the funnel data, that is third quarter U.S. GDP, came in at around 4.9% annualized, underpinned by a strong, fully employed consumer who spent freely in the summer across travel, out at restaurants, Taylor Swift concerts, and even some retail splurges. Enduring large amounts of fiscal spending has also been an economic propellant that many underestimated. This is a robust pace of growth. There's no question about it. It's the highest growth rate for any single quarter going back to 2021, which was a big year for growth, the biggest year for growth since 1984. But this speed will be hard to sustain. And we see a more challenged environment ahead for the consumer. For the US economy, the old adage goes, get the consumer right and get the economy right. So the direction of household spending will be key.
Thanks, Jason. And anybody else on the panel want to chime in with thoughts on the U.S. economy before we sort of dive a little bit deeper? Doug, I see you turning your camera on. I want to give you a chance to share your thoughts as well.
Thanks. Actually, I just was turning on my camera. It's like when you're in an auction and you accidentally, scratch your ear and you accidentally created a bid. But I always have something to share, and I'll just point out that it's so hard to predict what the market is going to be. If a year ago people had asked us, where do we think the market is going to be? 18. If we had said just under 20% by the middle of November, I think a lot of people would have thought we were crazy, right? So that's why it's so important to have our long-term allocation that Albion stresses and to stick to that, because while it seems obvious in hindsight when bad things happen that the market was going to go down, oftentimes the opposite happens as well. So that's my comment, Liz.
Yeah, Liz, I'd like to make an observation that, as Jason just highlighted, the economy's in great shape. It's actually doing very well, but you wouldn't know it if, depending on what you read and where you get your information. While the underlying numbers and the economic strength is really quite positive, boy, there's a lot of bearish sentiment and negative sentiment that's easy to see in the press. And yet what we have to do is get past that and actually look at the information, treat it as scientists, if you will, to see what's really happening. So it's very important to try to separate in your mind some of the things that you read, that a lot of hand-wringing going on with, and compare it to what is the actual data showing us. What the data is showing us is economy is quite strong.
Thanks, John. Jason, you mentioned if we get the consumer right, we get the economy right. A lot of the strong economic data we've been seeing has been driven by consumer spending this year, as you mentioned, and that's sort of been attributed to the consumer feeling good, both sort of from, pandemic stimulus that they still had in their bank accounts, as well as a strong labor market. talk to us about the labor market and what you're seeing, if you will. We've seen some softening there, certainly not a huge shift, but talk to us about the trends that are starting to develop with the labor market, please. And you're muted.
Sorry about that. That's a rookie mistake this far post-pandemic. So it's a great question. And overall, the labor market in the US remains healthy, but we do see some cracks beginning to form across hiring momentum, job openings, survey data, wages, and more. The job market is slowing. It's normalizing, I think, is a better way to think about it. We can also see this normalization on the labor supply side, which has finally risen over the past couple of quarters as more folks enter the labor force, which of course is a good thing as well. We need that for economic growth. Importantly, unemployment is beginning to rise as well. It's about 0.5% off of its cycle lows. We're at 3.9% today. We were at 3.4% at the cycle lows, which, by the way, was like a 55-year low. And while it's reasonable to say, well, that doesn't seem like much, it's only 0.5%. This is the way that it acts every time right before a downturn. The Fed thinks they can generate a soft landing. Economists are hopeful. But ultimately, higher rates hurt the economy, and the new direction of rising unemployment keeps going, and it sets off this negative tailspin until it places us into recession. The average rise of joblessness in recession is about 3.5% off those cycle lows. And if that were to occur this time around, that's about 7% unemployment. We've certainly seen worse, to be sure, but that would be a downturn. And so we're watching that normalization and that softening of the labor market closely to see whether or not it stops at just right or whether it continues to feed on itself. And the Fed's watching as well.
Jason, we were talking yesterday in one of our internal meetings about sort of the different areas, and I'm going a little rogue off the question list, everybody, so I'm putting him on the spot a bit. But we were talking a bit about like where we're seeing job gains versus where we're not seeing job gains, and I personally found that pretty interesting. I think maybe our clients would, our listeners would as well. Before we move on from the labor market, can you break that down a little bit for us?
Yeah, of course. So that really speaks to that hiring momentum piece that I mentioned when discussing the labor market. And early on in the economic recovery, we saw broadly distributed job growth across sectors and industries. Some of the areas that were shut down in the spring of 2020 saw the biggest gains in job growth, which of course makes sense. But all sectors were benefiting from a boom in the labor economy. Over the last 6 months or so, maybe even 12 months, we've seen a lot more staggered and even an uneven distribution in job gains among sectors. So, for example, the most recent jobs report that we got on November 3rd for the month of October, showed 150,000 jobs were added in the economy last month. But if you unpack where those jobs came from, all of them were created from the government, from healthcare, education, and leisure and hospitality. Why that's important is because government payrolls are notoriously volatile, lumpy, and hard to predict. So we kind of strip that out and look at private payrolls. In the remaining 100,000, if you strip out the government payrolls coming from healthcare, education, and leisure and hospitality, is a reflection of not so much a strong, broad-based labor market, but instead those sectors still trying to fill open seats that were lost during the pandemic. Those are the areas that had the most acute job losses in 2020 and 2021. So they're just trying to get back to even. And that's part of what's driving job growth right now. So it has slowed. And if you look at it through the lens of kind of the details under the covers, which again, Liz, is a great question, there are certainly reasons to think that things are normalizing.
Thanks for answering that. Details under the covers are always interesting. Any other labor market comments that the panel wants to make before we move on to the next question? All right. So kind of going back to the general economy, the word recession or rolling recession is still out there. We've been talking about the potential for recession, for at least the last year or so. What's our outlook for 2024? Do we think recession's likely? Well, John, you mentioned the economy is pretty strong right now. What do we think going forward? And I'm certainly happy to put that question out to anyone, Jason, if you'd like to, but also giving other panelists an opportunity to chime in.
I'll lead off. Unfortunately, yes, recession is still our baseline expectation over the next, let's call it 6 to 12 months. The economy has been resilient as we've described, but just because recession hasn't happened yet doesn't mean it won't. And I think there's a lot of opinion out there saying, well, look how strong the economy is, we can't go into recession. But the reality is, right before recession, we typically are growing or we're booming. So that's not unusual. Again, generally, when you spike rates, it has a negative economic impact that works with a lag. So that idea that the Fed can take us from 0% to 5.5%, nearly 5.5%, with over $1 trillion in quantitative tightening, all in 16 months, and not, and that economic pendulum, if you will stop from strong growth to perfect growth without going negative, just doesn't make a lot of sense to us. It would be ahistorical to expect that. And we can see this in our preferred leading indicators. I'm sure many of you have heard us talk about in meetings with you, our preferred economic leading indicators. We can also see this in some early signs that, as we discussed, strong employment is starting to slow and a robust consumer may be changing. And if you add to this those higher rates and plus the outlook for staying up here for a while, which is, what's known as higher for longer, we continue to reason that the odds of recession, obviously nobody has a perfect line of sight, but the odds of recession near term are elevated. So we're not out of the woods yet.
I'll jump in. Go ahead,
Mike,
Doug.
You go first.
Okay.
Go ahead, Mike. You first.
Yeah, I was going to jump in, Jason, and reference back to something you said earlier about, get the consumer right and you get the economy right. One of the data points that we look at is the month-by-month change in total consumer credit outstanding, basically the amount of money that consumers have borrowed. That's published each month by the Federal Reserve. And in the post-pandemic period, like the last 3-4 years, there's been a really interesting pattern in that consumer borrowing obviously cratered in 2020 because there was nothing to spend money on. It returned to a more normal level of growth in 2021. And then it was historically elevated in 2022 as some consumers anyway started to run out of pandemic era savings and they ramped up borrowing to sustain their spending. The trend this year, 2023, has been a sharp downturn. And that's potentially an indicator that American consumers, some of them anyway, are starting to reach the limit of how much additional debt that they can take on in order to finance their spending. Now, we haven't yet seen a knock-on effect into actual consumer spending. Obviously, Jason, as you noted, that was very strong still in the third quarter, but certainly something to keep an eye on as we look to the future. If borrowing capacity or borrowing comfort is limited, that could ultimately have a knock-on effect to spending and thus economic growth writ large.
Yeah, and I just wanted to add that yesterday the CPI numbers came out. Many of you probably saw that. Came in at 3.2%, and the whole world celebrated that. The numbers coming down. I just want to build on what Jason said. The Fed's job is not over yet, so we all need to be cautious. And a large part of the reason that CPI number was as dampened as it was is because of gas prices coming down, and the Fed doesn't control gas prices. So we kind of got lucky there. So we're definitely not out of the woods yet. So I just wanted to share that. It was a good sign, but there was some background info there.
Thanks, Doug. Your sharing of the CPI leads perfectly into our next couple of questions, which are about inflation. And certainly we cannot talk about the economy in 2023 without talking about inflation. It has trended lower throughout the year. One common question we get from clients is, you keep saying inflation is going down, but prices aren't going down. And it's really important to remember that as inflation comes down, that doesn't mean prices are going to go down. It just means that they're not going to go up by as much. So that's just something to keep in mind as we're thinking about disinflation versus deflation. Disinflation being inflation coming down, deflation being actually like prices are coming down. Jason, I'm going to put this out to you first, but what do you think is happening with inflation from here? We've heard sort of it may be harder to get to the Fed's target 2% from here than it has been, to get to the 3.2% we're at today from where we started the year.
Yeah, so I'm going to build on what you shared about the difference between price level and price growth, because I think it's an important distinction. And I've heard that question asked a lot lately as well. So when we talk about inflation, really these inflation baskets like CPI and PCE, we have to make that distinction between price level and price growth. Price level is the accumulation of price growth over time. So for example, since the start of the pandemic, overall CPI, which is the consumer price index, is the most highly watched inflation gauge, that's up about 19% from the start of the pandemic over the course of the second half of 2020, all of 21, 22, and now most of 23. This is the inflation that we feel when spending and doing our household budgets. It's the reality that a tall cup of Starbucks drip coffee is about $1 more today than before the pandemic. And these things add up and they are noticed. And yet, despite how unlikable inflation's general march higher can be, moderately rising prices over time is a sign of a healthy and well-balanced economy. So we want some inflation. Deflation, as you said, Liz, is bad. Ask Japan. And it's why many central banks have explicit inflation targets that are relatively gentle, like the Fed has a 2% inflation target that was created under Ben Bernanke 15 years ago. So that brings us to the price growth rate side of inflation. And when it's around target levels, the goal is for that to persist. That's the Fed's goal, is to keep inflation well balanced. When it's elevated, like it's been over the past couple of years, we want it to fall. And that's the disinflation that Liz just mentioned. And the good news is, and Doug spoke to this a moment ago with the most recent CPI, is that it is falling. Some context. In June of 2022, headline CPI was running north of 9% year over year. Today, with the most recent report we received yesterday, it's running at just over 3%. So we've reduced our inflation problem by nearly 2/3. And there are a variety of causes for the drop of inflation: normalization, Fed policy, supply chains being unclogged, goods demand coming down. There's a lot of reasons why we've seen this disinflation. But the overall message here is that it's subsiding. And of course, we welcome that.
And depending on the denominator you use, it's actually more than 2/3, because we're aiming for a 2% inflation rate. So if we're at just over 3 and we're aiming for 2, we don't have that far to go. When we were at 9, we had 7% to get to 2. So funny math, but it does highlight that a lot has been done to bring inflation back under control.
When we're talking about the economy, we're talking about interest rates, we're talking about inflation. The housing market often comes up. Certainly houses, homes are one of the biggest assets on our balance sheets. We've seen mortgage rates touch 8% or get pretty close to 8%. Home prices have stayed up relatively high. What are our thoughts on the housing market, Mike? Maybe I'll pass the mic over to you to start us off on this subject. There seems to be a lot going on there to unpack.
There is, and I'll start by talking a little bit about mortgage rates, because obviously that is a hugely important factor, and I'm sure everyone is aware. We all see the signs on Interstate 15 about where mortgage rates are at today. And I said last time on this call that we thought over the longer term, there was probably some room for mortgage rates to fall. They certainly haven't done that in the interim between the last call and this one, because as you noted, Liz, they did get up to 8%. They've eased back a little bit just over the last week or two, but we're still firmly in the 7% range. Our view longer term is still the same, which is that there probably is some room for mortgage rates to fall over the 3, 5, 10 years that are to come, based on where we expect inflation to ultimately shake out and the general interest rate environment. But when we say mortgage rates are probably likely to fall, we're talking into maybe the 5 to 6% range, let's say. Certainly not back to the 3% mortgage rates that we all enjoyed in the first couple of years after the pandemic. And so what does that mean for home prices? Well, obviously high mortgage rates hurt affordability, and that in and of itself, all else equal, will pull home prices lower. But all else isn't equal. One of the other kind of knock-on effects of high mortgage rates is that nobody wants to sell their house because so many people have low rate mortgages that they don't want to give up by selling their house and moving. And so it's really constraining supply, and the availability of existing homes on the market is really low. That has the effect of pushing prices higher. So even just within mortgage rates, there's kind of two countervailing forces here. Affordability is a challenge, which tends to pull prices down, but availability is also a big challenge that tends to push prices up. So that's kind of the mortgage rate picture. Jason, I know there's other factors that influence home prices. I don't know if you want to touch on a few of those as well.
I think you did a great job covering the bases. Totally agree with your assessment. And I think, inventory is the biggest variable that is going to dictate the direction of the housing market at the national level over the next 1, 3, and 5 years. That's the supply side, as you mentioned. On the demand side, I think the good news is if you're a homeowner, less good news if you're trying to buy a home, i.e. that affordability calculus. On the demand side, we're still seeing a bulge in terms of new household formation from the millennial population. Gen Z behind them is a fairly big cohort. So I think there's enough demand in the years to come to stabilize housing. The question is, what's the cost of financing, as you touched on? And then, of course, what's the available inventory? And there's been a mismatch of demand and inventory. And that's why we've seen, in part, these higher prices over the last many years, quite frankly, since the housing bottom in 2012. So it'll be interesting to see.
So we're not the only ones paying attention to mortgage rates and what's happening in the housing market. So is our friend Jerome Powell over at the Fed. And certainly they're a big player in the discussion about markets and economy this year. And one of the questions we're getting a ton is, is the Fed done? As we say around here at Albion, have we reached peak Fed? So to Jason or Mike or whomever would like to go at this first, what are we thinking about rates and monetary policy, and do we think the Fed is done hiking?
So I'll lead off with the top of the funnel monetary policy and Fed perspective. So as we said in July on our last conference call, we think the Fed's done hiking in the cycle, unless inflation or inflation expectations reaccelerate, or workers' wages pick back up due to a relentlessly tight labor market. And again, our base case is that the labor market is normalizing. Unless those things occur, they're very likely done. And when we listen to Jerome Powell speak, whether it's at the press conference after an FOMC meeting, or whether it's when he's giving a talk or moderating a conference at the New York Economic Club, whatever it may be, Powell sounds like he wants to be done. I think that they think they've done enough. And the data largely supports that, namely the inflation data. So they'd probably like to just sit back at this point and let the monetary policy lags do the work from here. Again, going from 0% to almost 5.5%. At the same time, bond yields have done some of the work for them since the last time they raised rates in July. The 10-year yield, the 10-year Treasury yield, is up about 2/3 of 1% since then. It was up over 1% from those July levels until just recently. So the general message is we've had a lot of financial tightening in the system. And while they can't yet say mission accomplished, things are certainly on the right course in terms of their battle against inflation. So yeah, we think they're done.
I'll jump in real quick too, just to point out that futures markets, and I think many of our clients are aware that there are futures markets for overnight interest rates where there's essentially an implied probability based on where those futures are trading of additional rate hikes or rate cuts or what have you. And over the last couple months now, really since the last time the Fed did their last rate hike, there's been sort of a debate within futures markets of the probability of one more 25 basis point rate hike. As of yesterday, after we got that CPI print, the implied probability of another rate hike is literally 0. And it's the first time. I have it on my screen in front of me right now. It's literally 0.0. So any sort of remaining notion that market participants might have had that, okay, we might still get one more rate hike, that is gone as of yesterday.
And I'll add 2 points that I think are interesting. The first is always remember that the Fed wants us to think that there could be additional rate hikes in the future, because that alone helps dampen the expectations for future inflation. It helps them. So you may hear some scary things come out of the Fed, but that's by design. If they do that right, they may not actually have to hike the rate. The second thing is Jason mentioned the 10-year Treasury. And I think looking at what the rate is on the 10-year Treasury is really interesting for all of us, because that gives us expectations of what investors think inflation is going to be like in 10 years. So the Fed controls the short end, controls, the short term rates, but they don't control the 10-year. And Mike, I know you and I and with the whole investment team have had discussions. Share with the audience just how much the 10-year rate has dropped since the October high in the rate there.
Yeah, about 0.5%. It's this year in general, there has been a lot of volatility in interest rates, not just this year, the last several years, because of inflation and what the Fed's been doing. But even just the last 6 weeks, like if you go back to late September, 10-year Treasury was around 4.5%, which is roughly where it is today. And then in a very short period of time, it went up by 0.5% and got as high as almost 5%. It never actually closed above 5%, but it did trade there intraday very briefly. And then just in the last couple of weeks, that 0.5% that it increased has come right back out. And so now we're back down to about a 4.5% on the 10-year. And I mean, our kind of longer term view there with respect to, where rates writ large are going, the answer is probably a little lower if we're right about inflation and the Fed gets that back to its target. A sustainable kind of 10-year yield is probably more in the 4% range ish, not necessarily 4% plus, which is where we are now. So there's a little bit of room for longer term rates to come down, but much like I said with mortgages, no expectation that we're going back to ultra low interest rate environments like we were in for a couple of years out after the pandemic.
So one of the impacts of the Fed raising rates, as we've been hearing about in this call and others, is that we've started to actually earn something on our cash for the first time in a while. And we've had lots of clients asking questions about money markets as a cash equivalent instrument that is now paying north of 5% most often. And just last week, I had a client call up and say, Liz, what's the money market at Schwab paying right now? Or we've had clients reach out and say, is that a good option for parking cash? Or maybe feeling a bit uncertain given, what's happening geopolitically in the world right now and wanting to, take some chips off the table or keep some cash on the sidelines and wondering if money markets are a good option for that. And before we address those questions, I want to make sure we all know what money markets are. And so the money markets, the tradable money markets that we're buying for our clients, those are actually mutual funds. And those funds hold really, really short-term, high-quality debt instruments. So think treasury bills, think CDs, think really short-term corporate bonds. And they set the price at $1 per share. And the rate is based on those underlying investments that are held within the fund, and it tracks really closely to what the Fed funds rate is. But that rate can change based on what the investments in that fund are. And it's not guaranteed or locked or set. And when you hear those rates quoted, it's important to know that those are annual rates. So if you hear somebody say, hey, I'm getting 5.5% on my money market, What that means is if that money market continues to pay out at the current rate for a whole year, for a whole 12 months, and you own the fund for that whole 12 months, then your rate of return on that money market is 5.5%. So I think that's something important to note, because we hear that rate thrown around, but sometimes understanding what it actually means or translates into what you're going to earn in interest on your money market can be confusing. Going back to those questions, is it good to park cash in money market? I think it really depends on what the cash is for, why you're doing it. So if you have cash that you know you're going to need in the next 6 to 12 months, maybe 18 months, or if you're beefing up your emergency fund, maybe you have your 3 to 6 months of living expenses in cash on the sidelines, but you're thinking now's a good time to maybe bring that up to a year of living expenses. Money markets can be great options for that. I mean, we're earning generally more in money markets than we are in our checking or savings accounts at the bank. They're pretty stable and they're liquid, meaning, we can move in and out of them. But if we're parking cash there, that's part of, our fixed income or our equity allocation, we're potentially shortchanging our future selves for what feels like an easy 5% today, or might feel like an easy 5% today. And really what I mean by that is, think if you're taking cash that is part of your fixed income allocation, and remember our fixed income allocations, the purpose of that is to provide capital preservation and, some stability, and in this interest rate environment, even some income. If we're taking cash that should be part of that allocation and we're parking it in money market, well, we're missing out on the opportunity to lock in the rates that we can currently earn on bonds, which are at least comparable, if not better, than what we can get in money markets. And those rates we can lock in. We can know that we're going to get them for a number of years, where money market rates are going to change. They're going to go down at some point. And when those money market rates go down, so will rates on bonds across the board. So if having fixed income or a fixed income allocation is appropriate, we don't want to miss out on the opportunity to lock in the rates that we can see on bonds today. If we're taking cash that's part of our equity allocation and we're putting it in money market, to use a phrase that Jason often uses, we're taking 10-year money and we're turning it into 10-month money. And what I mean by that is, the equity allocation, that's really for long-term growth potential. And we're not going to get that in money market. That's not the tool for long-term growth. So we want to make sure that we're not being too short-sighted with those dollars. And if we're taking money out of our equity allocation and parking it in money market because we're uncertain, there's probably a couple of things going on there. First, we're probably trying to time the market, and I use we like the royal we. We're probably trying to time the market or time a re-entry into the market. And as you've heard us say over and over again, trying to time the market can be a fool's errand. And we're waiting for some time period where we feel certain about investing in stocks. And I think that's probably unlikely, or those periods where everything feels really calm and good don't happen that often. There's always something we can point to that makes us feel uncertain about investing in equities or investing in stocks. So we just, and when times are scary, that's generally the best time to buy stocks. So we just want to make sure that we're taking the right view and not using money markets to skew our overall asset allocation. Because as Doug referenced earlier, our overall asset allocation is really about us. It's about our goals, our needs, our risk tolerance, not what's happening in the market, in the short term, or what's happening in the market today. So with those thoughts, I will open it up to the panel to see if anybody has anything to add. I know, Mike, we've had a lot of discussions about this internally, both on, the role of money markets and specifically sort of money markets versus fixed income. I'll turn it over to you if you have anything you want to add.
Yeah, for sure. I'll jump in with a quick analogy here. This is a super important topic and probably the most frequent question that we're getting from clients. I think we all know this. Successful long-term investing is a lot like exercising and eating healthy. It's about long-term results. It's about good habits. And sometimes it's about doing the hard thing in the moment and delaying instant gratification in favor of a better long-term outcome. I mean, Jason says this all the time. It's simple, but that doesn't mean it's easy. So here we are in this analogy as long-term investors eating healthy with our plate of fish and broccoli for dinner or whatever your healthy food choice is. And what has the Fed done? They have plopped a giant bowl of ice cream down in front of all of us. That's what 5+% yields on cash are. They're like a big bowl of instant gratification. And it's really, really tempting. Believe me, I love ice cream more than anyone else on this earth, so I get it. But this is a moment where our discipline as long-term investors is being tested. Because as great as that ice cream tastes at 5%, it's not good for us long-term. It's not as good as what we can get from other investments. And Liz, you made this point very well. We can get yields higher than that in fixed income right now. We can get them for a longer period of time. And of course, we all know what history says about the earning power of the stock market on a long-term basis. And just to, I guess, finish out the analogy, in addition to being long-term unhealthy, what's the other kind of bummer about ice cream? It's that it melts. And that's exactly what's going to happen to cash yields over time. They're high right now because, as we've just discussed, we're at the peak of the Fed hiking cycle. But overnight interest rates at these levels are not here to stay. In fact, if you look at, I mentioned earlier, futures markets are showing a zero probability of additional hikes. Well, what they are implying is that at some point in 2024, the Fed's going to start cutting overnight interest rates. And the Fed's own projections also suggest that maybe in 2024 and certainly in 2025, 2026, they're going to cut rates. Yields on cash are going to move lower in lockstep with what the Fed does during that time. So that bowl of instant gratification that we have in front of us right now is not here to stay and certainly should not be a substitute for the long-term investments that are there as part of our financial plan.
I always like to think, what are the couple of tidbits, main points that we're leaving our audience with? And I don't know about the rest of you, but for me, it's that my bowl of ice cream is melting and my 5% rate in the bank, my money market, is probably going away. So Mike, that's a great soundbite. Thanks for sharing that with us. There was a question in the chat about, what about CDs instead of money market? And Liz mentioned earlier your emergency fund. We always recommend that people keep some money at your local bank. You go down to the end of the corner, you use your ATM, you take money out. You should have liquid assets. That said, a lot of bank accounts, my bank as well, my personal bank accounts at Chase, my personal savings account basically gives me $1 of interest for every $10,000. It's 1 basis point, so it's very, very. I think it's a penny actually for every $10,000 that I hold there, and I can get 5% in the 6-month CD. So for but the question is, can you access that CD when you need to? And a CD is essentially a contract with your bank. So you need to ask that question and you need to see the answer in writing. It's all electronic now, but if you go into your bank, you can say, show me the contract and show me where, I can get access to my 6-month CD in 3 days notice or 1 day notice, whatever it is. And if you can get that, rather than keeping that money in low interest rates, let's say you want to have $100,000 at your local bank for the emergency fund that Liz was talking about. If you can get that money in 24 hours or 48 hours, you're likely going to give up the interest that you earned over 6 months. But in my case, I wasn't earning any interest anyway. So for me, I've made the decision, my emergency fund is in a 6-month CD that's paying 5%. Some banks are at 5.5% right now. So hopefully that answers the question about CDs.
So I did notice that when this whole question stream came up, every panelist unmuted. Apparently we all have something to say. So, and it's an important question. I'd like to make an observation. When we started Albion in 1982, money market rates were about 20%. That's amazingly attractive ice cream. I don't know what your food analogy is for that one, Mike, but it's a heck of a bowl of ice cream. But equity prices were quite low because we'd come out of the 70s, which was a very difficult period for equities. You could buy a triple tax-free 30-year bond that was paying 12%. Now that 20% ice cream was super attractive. But when Toby and I began Albion, we went for a more balanced diet. We did not invest just in ice cream. We said, all right, we're going to own our broccoli, which was fixed income, and we're going to own our fish, which was equities. And it turned out a lot better because that ice cream melted away over the following years. And as it melted, as rates dropped, we saw the value of those other assets, of course, appreciate dramatically. So this notion of don't invest 10-year money into a 10-month offering makes a lot of sense. The CD question, I think, is a critical one. Personally, I'd rather own a money market fund with the liquidity and the diversified credit risk. If I buy a CD through my bank, I am at risk of my bank failure or my bank having problems. Clearly, FDIC insurance covers it if it's below a certain amount. But I would rather own the money market fund, which is dominated typically by treasury securities and high quality short-term paper, and I have that liquidity without giving up interest. So a lot of ways to skin that cat, but I prefer the money markets.
All right. I'm going to shift gears a little bit. I want to make sure we have a chance to touch on a few more topics. Certainly, there's a lot of talk about what is happening with U.S. debt right now. So our conversations about higher interest rates and what we're earning on our cash also means that when the government borrows money, they have to pay more for the pleasure of borrowing that money. And that's brought up some concern about, growing deficits. Jason, can we hear from you on sort of what we're thinking about, wider deficits as a result of higher interest rates?
Sure. Yep. Definitely topical and hearing more about this as rates rise. So the most recent data as of September 30th showed a U.S. federal deficit of 1.7 trillion over the prevailing 12 months. That's over 7% of U.S. GDP. And for context, this is a record outside of war, recession, or national emergencies like a pandemic. Historically, when deficits top 5% or more of GDP, unemployment is over 7%. Today, we have about a 7.3% deficit to GDP ratio. And yet, as we discussed earlier, unemployment is 3.9%. Yes, it's up 0.5% off the lows, but it's still at generational lows if you go back over 5 decades. So we have a fully employed economy, yet we have huge deficits. So if you read what the Congressional Budget Office says and projects, they say if we do nothing and if rates stay elevated, then the tab for interest alone as part of the line items in the federal debt or the federal expenses will top 1 trillion in the next couple of years. And that's a big, big, big number. I mean, I remember when they were 200 billion, 250 billion, and we were talking about the level that we're spending on our interest expense. An undeniably higher for longer monetary policy, which we've talked about, has real implications for the cost of servicing that federal debt, just like zero interest rates did in the 2010s up to the pandemic, where we were able to borrow at very low rates. Putting like a numerical layer to this, the average weighted interest rate for the federal debt is currently just under 3%. It was about 1.5% just 14 months ago. So you can see the impact of what the Fed has done and what yields and rates have done over the last year or so. Going forward, more than half of all U.S. Treasury debt will mature over the next 3 years, meaning that the average rate and thus total interest expense is likely to rise further. And so the concern among economists and among market strategists and investors and really everybody is that this growing piece of federal outlays toward interest expense can create what's known as crowding out effects in the economy. And it can also create a negative feedback loop in terms of yields going higher as bond investors demand more compensation for ever widening deficits. But to be clear, we don't consider either an imminent risk to stocks or the economy, but it clearly needs a course correction, and we're all watching it very closely.
Yeah, it's gotten to the point where the amount of debt that Treasury issues kind of matters in terms of there's only so much that the market can take. And one of the things, ironically, that has pushed yields lower recently is this sort of arcane document called the Quarterly Refunding Plan that no one used to care about, which is basically the Treasury's announcement to the market of how much, 2-year, how much 10-year, how much 30-year debt they're going to issue. And when that came out a couple of weeks ago, actually on the same day as the FOMC, it was sort of less bad than the market feared, in that there was going to be less Treasury debt that had to be absorbed by the market. And that's one of the things that pushed yields lower. So the market is certainly more attuned to exactly how much debt is the US Treasury issuing than it had been in the past.
One question that came in that's very timely to this particular topic we're discussing is the role of China in buying U.S. debt, and is there any fear that they're going to stop, buying U.S. debt, and that will have a negative impact, potentially sending yields higher?
Yeah, China and sorry. And I was going to say also Japan, honestly. Japan for a long time, the Bank of Japan has engaged in what they call yield curve control, where they have been suppressing yields on their own debt, Japanese government bonds, to a pretty significant degree. And that has pushed a lot of Japanese investors, large Japanese banks, to buy U.S. Treasuries just because there was some yield available in Treasuries, less so, or to a much greater degree than in Japanese government bonds. Anyway, the Bank of Japan, for various reasons related to the global inflationary environment, is loosening yield curve control, potentially abandoning it altogether over time. We'll see. But if that allows Japanese government bonds to the yields on those to rise, such that the relative value between them and Treasuries changes from the perspective of a Japanese investor, they could have less appetite for Treasuries. And you mentioned China. I think it's an open question as to global demand for Treasuries outside of the US. And it's another thing that the market is no longer just assuming will be there, where in the past, it seemed that there was an almost unlimited appetite, or certainly sufficient for anything that the Treasury would want to issue from the global buyer base. And that is not as assured anymore as it used to be.
Yeah, I'd have to break that question into two parts. There's an economic question and there's a political question. The economic part is easy. There's a price at which the United States can attract foreign capital to finance its own debt. And that just means higher interest rates, a higher cost to those of us paying off that debt. The political question is, does China perhaps see it to its advantage to not buy US debt and cause the US economic problems? That's a whole lot harder to answer because we are so intertwined with both China and Japan, and it's not in their interests to see their biggest market struggle, because then that will cause their economies to struggle. So we tend to focus more, despite all of the vitriol that you might hear in the political environment, on the economic issue. And it's more about what's the cost of financing the debt rather than will we be able to finance that debt.
Yeah, and I'll add a little extra as well. I like this question because it really gets at the heart of, U.S. Treasury yields in the bond market, which we've been in interest rates, which we've been talking a lot about on this call. And it's this idea, as Mike mentioned, that, because of the large and mounting deficits that are happening, we're seeing large Treasury supply. And can the market absorb that amount of supply? That's a big question. And it's in part why yields have been going up. But on the other side of that, the question of can we absorb it is a function of two things. At least it has been historically over the last couple of decades. One is the Fed as a big buyer of US Treasuries. They have been, but as I mentioned in one of the other questions when we were talking about Fed policy, the Fed has been engaging over the last year and a half in what's known as quantitative tightening, or QT. So they've been stepping away as an incremental buyer of US Treasury debt. So that's one element of the demand stool that's been removed. Looking overseas to our foreign buyers, as Mike mentioned correctly, Japan has been slowing in terms of their net purchases of US Treasuries. China is a big question because of the geopolitical tension between the United States and the second largest economy in the world. And I think the good news is that it's worth mentioning that today in San Francisco, on the sidelines of the Asia Pacific Economic Cooperation Conference, President Biden and President Xi Jinping plan to meet. They're going to silo themselves off into a room, and they're going to discuss these issues and much more. There's a lot of topics that are going to be on the table, reportedly, between reestablishing of military to military communications to avoid confrontations in the Pacific. They're going to talk about AI. They're going to talk about the status of Taiwan. They're going to talk about the conflicts in Ukraine and the Middle East. President Xi Jinping is likely to ask for some rollbacks of the tariffs that were put into place under Donald Trump and that have been largely kept in place under President Joe Biden. So we're encouraged by the fact that at least the two presidents of the two largest economies in the world, one of them being a large buyer of US Treasury debt, are having a dialogue. So we celebrate that, and of course we'll be watching for any news that comes out of that.
I know we and a lot of people will be watching that very closely and trying to interpret what meanings will come from that dialogue. We're coming up on an hour, but I want to, before we wrap up, just have a chance to answer some of the questions that have come in specifically related to the equity markets, as that's certainly always a hot topic. And there are a lot of things that impact what's happening in the stock market. I guess to summarize, where are we now market-wise? Are we in a bull or bear market? And where do we see the market going over both the near term and the longer term? I know predictions and forecasting is our favorite thing, and I say that with total sarcasm. But Jason or anyone on the panel want to lead us off? I'm sure we'll have lots of comments to make on this, but want to make sure we get to this before we sign off this morning.
So I'll start with the question of, are we in a bull market? I think the simple answer is, for a slice of stocks, yes, but for most stocks, no. At the market cap weighted S&P 500 level, which is the common benchmark we're all familiar with, the index has bounced off of the lows from late last year, though that move has almost exclusively been due to a handful of large cap winners, especially in tech. We aren't seeing broad participation in the market, which is something that typically occurs in a true durable bull market, at least in the early stages. That's what you see. Numerically, from last fall's bottom, which was in October, the S&P is up by over 20%, which is the arbitrary threshold for defining a new bull market. And look, in the beginning of that move, through like the first 4 months of the move off those October lows, we did have that broader participation. The S&P 500, NASDAQ, Dow Transports, mid caps, small caps, even international stocks were all finally starting to rally. But over the past 8 months, really around the time of the Silicon Valley Bank failure, we've seen a stark divergence in the market, in the equity market. It's been a handful of mega cap winners driving the S&P 500 and NASDAQ, with most everything else struggling. It's almost like there's an S&P 10 and then there's an S&P 490. And that's the forking that we're seeing in the equity market. So from point to point, October of last year through today, we aren't seeing what you would typically experience in a genuine, sustainable new bull market. That is just kind of everything sort of goes up. In particular, worth noting the contribution and indeed the outperformance of small caps, which before yesterday's big move up, they were up 5% yesterday. Before that move up, they were actually down over this period from October of 22 through yesterday. Historically, small caps lead, often by a lot. They lead other equity categories in the first year of a new bull market. And again, we're just not seeing that. Banks also tend to lead and sprint ahead in the first year. We're not seeing that. So this situation has us somewhat skeptical of what we're calling a skinny bull market and its ability to thrive. And there might be reasons why this time is different. There could be that disclaimer, but we found that over time, that's usually not the case.
And I'll real quick just tie it also back to the discussion we had earlier about the economy, because Jason, I think you'd probably agree, whether history ends up concluding that we are already in a bull market or whether we're sort of still in this extended bear market is going to depend on the direction of the economy and whether we avoid recession or not. History tells us that in recessions for some period of time, stocks tend to not do all that well. If we are getting close to entering a recession, it could very well turn out that there's some turbulence ahead before the bull market springs anew on the other side of that. So that's my it depends comment.
It's a great point, and I think it pivots us to the second part of the question, which is kind of what's our outlook. And obviously forecasts are hard, especially about the future, as Mark Twain once quipped. But as we look out over the next 1 to 2 months, like who knows, right? 1 to 2 years from now, it's hard to say how stocks will adjust to things like macro volatility, increased geopolitical unrest, higher deficits, higher rates. And in that space between, which is what Mike's referring to, let's call it inside of the next year, if things go just right and we avoid recession and inflation and interest rates are benign, then I'm rather hopeful that stocks can do okay. And we might be in the context of an early bull market. But if our current recession call proves correct, and we discussed why we think recession odds are elevated, then we expect one final leg lower in what's been a pretty challenged period for stocks off of those late 2021 highs. Looking out really long term over the next, let's call it 1 to 2 decades, we think stocks will largely do what they've done historically, which is they provide mid-single digit real returns, that is after inflation, to investors, and will be the growth engine for portfolios. So I think as an investor, you've got to be there if you have a long-term outlook. And I'll just wrap up by saying this bullishness over the long term kind of really comes from being generally upbeat on the important market driving structural fundamentals that drive stocks. That is a dynamic US economic system, rising prosperity, growing corporate earnings, reasonable inflation levels, favorable stock market demographics. I know there's a lot of talk around just overall demographics aging, but if you look at the cohorts that are buying stocks for IRAs and 401ks, I mean, that looks encouraging. And there's this overall allure of the inherent opportunity in equities for the masses. So Buffett calls all of this, Warren Buffett calls this the American tailwind. And we agree that that's still intact. So longer term, we remain bullish on stocks.
And I just want to share one last thing. I know we're 2 minutes or 3 minutes past, but I want to encourage everybody on the call. We've spent a lot of time talking about the investment side of the work that Albion does for you, but an equally important part is the advising side. Liz, you opened talking about, we're November 15th, some year-end planning. Know that there are some things that have a calendar year deadline that we have to get done by 12/31. And the service providers that work with Albion, like the custodians you're at, Charles Schwab, Fidelity, et cetera, they have their own deadline. And sometimes it's very common for us to get requests the last week of the year, right? Because many of us are off of work. The last week of the year, we have a little more free time. And it's a lot easier to get some of these things done now. And it can really be out of Albion's control if like Schwab can't get something done on December 29. So I'm just going to share a couple things very, very quickly and encourage you to reach out to your primary contact, your senior wealth advisor at Albion if any of these things ring a bell. Liz mentioned RMDs. There's also flexible spending accounts, FSAs, that many of you have. Those are use it or lose it accounts. So I encourage you to look at those. Your 529 account, that has a calendar year deadline. And if you're in a Utah 529, they have their own deadline. So please don't wait to the last week of the year to do that. Putting money into your 401k or your health savings account is something. Harvesting investing losses is something we're doing behind the scenes on your behalf. Giving gifts to adult children. Right now, both spouses, each spouse can give $17,000 a year to each child. So for one child, mom can give $17,000 and dad can give $17,000. And And that's a use it or lose it by 12/31. So that's something, if you're thinking about gifting, that's something to maybe reach out to Albion and talk about. Let's see what else I have here. If you have quarterly payments, if you make estimated payments, your fourth quarter estimated payments not due until January. But if you pay that in December, you can use that for your state tax. You can actually use that as a deduction in 2023 instead of 2024. And the last thing to share is I'm not an accountant. So, that's really the things I shared is in an accountant area. We do have a lot of expertise on that. And the last thing I'll say is if you don't have an accountant and you'd like a referral to one, please let us know. And if you have an accountant that you love, great. We love working with your accountants as well. So with that, I know we're 5 minutes over now, so I'll turn it back to Liz.
Doug, thanks for taking the time to highlight those. It is really important, and the custodian deadlines are a real thing. We always do our best to get, last minute requests submitted, but it is a tad out of our control. So the earlier we can get, year-end planning items taken care of, the better. So we've shared a lot today. We've covered a lot of ground. We weren't able to get to all the client questions that had been submitted. If you had a question that we weren't able to get to, if we know you had it, we'll certainly follow up with you after this call and make sure we answer it for you. Or if you didn't ask it in the chat format, please don't hesitate to reach out to us. We're always happy to discuss client questions at any time. The one big takeaway I want everyone to have from the call is that, whatever happens in 2024, we'll be here to talk about it with you and to help guide you through it. Also, just one last housekeeping item before we end the call today. I am in my office at the Albion building, and many of you probably know that we had the great flood of July 2023, but we are in the home stretches of restoring the Albion office to its former glory. And as soon as we're fully up and running again in here, you'll be the first to know. So thanks so much for joining us today. We always appreciate having your attendance and your involvement, and we'll see you next year. Bye, everyone.